Hello everyone, happy US election eve. My name's Craig Erlam, Senior Market Analyst at OANDA. Welcome to today's US Presidential Election 2016 preview. Now, the US election, of course, takes place tomorrow. We've seen a lot of market hype surrounding the election itself. Of course, the election now is between the two main candidates, the Democrat candidate Hillary Clinton and her Republican opponent Donald Trump. Now we've seen a lot of movement in the markets over the past couple of weeks. We saw Hillary Clinton, of course, get quite a sizable lead in the polls, only for the FBI a week last Friday to reopen its investigation into her emails, which they had previously concluded she was not guilty of any legal wrongdoing, and from then is when she really started to propel forward in the polls. The reopening of the investigation cast doubt once again on whether she had actually done something wrong, and her poll lead really was absolutely obliterated in the short period after this. And we saw the resurgence of Donald Trump, and in effect we saw the resurgence of the Donald Trump risk aversion trade, with the markets clearly showing a preference for a Hillary presidency. I think primarily because Hillary Clinton represents continuity and certainty, and Donald Trump represents the one thing that the market hates more than most other things, which is uncertainty. Uncertainty about his policies, uncertainty about his relationships with respect to foreign policy, uncertainty in relation to fiscal matters, monetary policy, due to his constant criticism of the Federal Reserve, uncertainty, basically among a number of key issues for the markets, which is why we do see this more risk aversion play when Donald Trump does close on the polls. Speaking of the FBI investigation, you can find out more about this on the MarketPulse website. We've got a lot of articles today covering it from different angles. You can see the most recent one from Kenny on the dollar, Canadian dollar, and the impact that the latest FBI announcement had on that. I wrote a piece earlier on about how this impacted things like gold, and how we've seen the risk rally benefit oil this morning, and what it also means in terms of the election itself. We've seen obviously a piece from Dean earlier on, speaking in the run-up to the election itself. If you look on the Market Pulse section under macroeconomic here as well, you can see that we also had a piece written by Stephen in Singapore earlier, looking at this from the trading desk, and also more from an Asian perspective as well. So he offers an alternative point of view also here, like I say. So I think if you want to find out more about what happened over the weekend, then by all means check out the OANDA Market Pulse website. You should get plenty of information there, both in terms of the event itself, but also the impact it had on the markets. One other thing I wanted to highlight here before we do take a look at some charts is the impact of the polls. We've talked about how Donald Trump closed the gap quite dramatically on Hillary Clinton following the revelation a week last Friday. You'll see on the polar polls here, this is from Real Clear Politics website, that while we did see Trump close the gap in the polls, from the gap was really quite significant between 7 and 10 points. They closed the gap right to around 1.3 points according to the polls. This is of course an aggregate of all the different polls which have been released, but you can see now over the last couple of days we have seen that poll gap widen again. This, I think, one of the reasons I think this has widened is because we've had time to absorb the information, and the initial knee-jerk reaction to the Clinton emails was maybe a little bit overly sharp, and I think the revelation yesterday evening is also helping to widening the polls, but I think that will probably have more of an impact over the next 24 hours as well. So clearly, while the momentum of the last week was very much with Donald Trump heading into the election, I think the comment by the FBI on Sunday evening has certainly boosted Hillary Clinton's campaign and very much given her the momentum heading into the election itself. In terms of the charts, we have seen a lot more of a risk play in the market today on the back of these revelations. You can see that the dollar's been very much boosted. This is the euro versus the dollar. Very strong rally in the dollar on the back of these revelations, gone from a 111.40 straight through to around 110.30. So more than 100 pip rally on the back of that. I don't think it's that much of a coincidence really that this occurred around a key zone of resistance. We hung around this key zone of resistance for around 3 days, despite the fact that the gap between Clinton and Trump was getting smaller. This is where the charts I do think do have an impact. While the fundamentals we're pointing towards further dollar weakness, this resistance zone continued to hold, and as soon as we got a positive story, we saw this smash back lower. So we've gone from 111.40, and now we've tested the 110.50 level, and it looks as though we're breaking through that, and we may have headed back for the levels which we were seeing prior to the revelations on the Clinton emails a week last Friday. And it's because of this, for example, that I don't think, in my view, a Clinton victory is as priced in as some would suggest. We've seen some of the betting markets, for example, suggest it's around 83% priced in. I'm not really convinced that the markets are pricing it the same way right now. There is a couple of reasons why that may be. One, I think the shock from Brexit 4.5 months ago is still very much ingrained in the memory of traders. And that, for those of you who remember or don't remember, that Brexit was 90% priced in on the evening of the Brexit vote itself, and we saw how quickly that unwound and how big a shock that had on the markets. And I think what people are looking at here with Clinton is seeing that the betting markets are very much along the same lines as they were with Brexit, but people are maybe not getting quite as carried away as they did previously, although I think we are, broadly speaking, seeing a Clinton victory being priced in at this stage. You can see with cable as well, we did see that spike higher in the pound late last week. We went through the resistance level to around 125.50, but again, now we're trading back below 124 on the back of this news. If we break back below 123.30, then it would see us end up move back in towards this range, which in the event of a Clinton victory, I do think that would materialise, and if anything, I think we could potentially see these 121s coming under some pressure, because not just of the certainty factor, which I think that would bring, as I said, which is what the markets seem to prefer. It's also what it means for the Federal Reserve as well. We've got to think about this from two angles. One is the impact on the US economy and the certainty or uncertainty that a certain result would bring. The other is the impact on the Federal Reserve. If we see a Clinton victory, continuity, calmness in the markets, then that provides the conditions favourable for the Federal Reserve to raise interest rates in December, as it signalled it would like to on a number of occasions recently. Most recently, though, in the FOMC statement. We also had that decent jobs report in the US as well. A Trump victory and the uncertainty that would create, the potential for significant market volatility in the event of a Trump victory, could deter the Fed from raising rates, as it did around the Brexit vote itself, as it did earlier on this year in January, when we saw the weakness in the Chinese yuan actually spark excessive market volatility, which created bad conditions for the Fed, as far as the Federal Reserve is concerned, conditions that the Federal Reserve did not want to become embroiled in. We saw a similar reaction last August as well, August 2015, when we did see significant market volatility. I think a Trump victory and the volatility that would follow would potentially deter the Fed and push it back to next year. And I think the markets would look to price that in as well, which would lead to further weakness in the US dollar. We've got dollar CAD here. The Canadian dollar also suffering along with the US dollar, if not more. The Canadian, of course, Canada has strong trade ties to the US economy. And Donald Trump's references to NAFTA, tearing up NAFTA, which is of course very extreme, means that the Canadian dollar, the Canadian economy is vulnerable, more vulnerable to a Trump presidency than it is to a Clinton victory, and therefore again, this is why we're seeing one of the things is Canadian dollar weakening, not necessarily to the extent of the peso, which we'll touch on in a sec, which is far more vulnerable. Mexico export around 80% of Mexican exports, I believe, go to the US. That's very vulnerable to a Trump presidency. Canada the economy is more diversified, so it's less vulnerable, but we are seeing Canadian dollar weakness on the back of any resurgence in the polls for Donald Trump. You can see that we reached around 134.50 here quite recently. We are seeing the Canadian dollar actually benefit a little bit more than the US dollar now from the revelation yesterday evening. We do seem to have found a range around 133.50 through to 134.50. I think it is going to it may take the result itself to spur a move outside of this boundary, and I think, like I said, Clinton victory would probably benefit the US dollar more than it would benefit the Canadian dollar at this stage due to the implications it would potentially have for a rate hike. Although maybe that trade today where we're seeing stronger Canadian dollar on the US dollar maybe would signal otherwise. Although all things considered, I think the biggest reactions that we're going to see here is not going to be seen in the dollar Canadian charts. I think things like dollar yen, dollar peso are far more vulnerable to a Trump to the result, sorry, tomorrow evening, more so than say something like the US dollar versus the Canadian dollar. The dollar yen, as I say, we've seen a very strong reaction back towards 104.50 from 102.75, 103. Again, what we're seeing here is very much the ultimate risk on versus risk off trade. I think the only pair that I can think of that will see more of a reaction than this, you could potentially see a similar reaction in dollar Swiss, because you're going to have the risk on currency versus the risk off currency. The Swiss franc always seen as the risk aversion play in a very much the same way that the dollar yen is, but the other one, of course, as I've already said, is the dollar peso, given that the peso is very much seen as the ultimate Trump risk barometer because it's the most vulnerable to a Trump victory. But as you can see, we've very much seen risk on play here today, and we're back at around 104.50, close towards the 105.50 levels that we reached prior to the Clinton email revelations. We've survived the test of the Ichimoku cloud, both in terms of the lagging line and the price action, but also the moving average bands, the 55.89 moving average bands offered strong support. Again, I don't think this is a coincidence that the price held up around these levels. I do think we've seen on numerous occasions that these moving average bands have provided significant support and resistance, particularly over the last year. So the fact that we've seen this happen again doesn't surprise me. You can see that since we broke below here on 1, 2, 3, 4 occasions, we saw that provide significant resistance until it finally broke through, and now we've seen it providing some support. The fact that it held above this level showed that the market remained bullish despite the temporary bearish sentiment that we were seeing in the markets. Aside from dollar CAD, like I say, aside from dollar yen, the other risk on risk off pair is dollar Swissy. Swissy always favored as a risk off indicator. This has been trading more sideways compared to the dollar yen as of late. You can see that the longer term trend is very much still in play. This was the move from January last year, the SMB move, which created this ultimate low, which I've ignored for the purpose of this trend line, because I do think that was an extreme move. And as you can see, if you take the trend line from these two lows, the market has continued to track these higher. So as far as I'm concerned, this falls in the extreme case, and the trend line has shown suggests to me that we are following this trend and we're not paying much attention to that one extreme move. Now you can see that we've got this clear zone of support and resistance here around 99.50 through to parity. Really 99.50 offers the major zone of resistance, as we've seen back in May, again in July, and then most recently again in October. We did go through to parity briefly and pull back, and that'll be a notable level of resistance. But should we break through 99.50, then I think we could be headed back towards around 101. That'll be your next level of resistance, and above here you're looking at around 102.50. Whereas a Trump victory, and therefore the risk averse play, would see the 96.50s come under significant pressure, and I think that would not hold for very long. I think the risk averse play could be quite strong on this one, but the significance of this would mean that we're taking out previous lows, but we're also taking out that long-term support level. We could find some support potentially around 95.50 or even these 95s, 94.50, 95 levels, which is what we've seen really throughout this period from September of last year. But I don't think, especially following the Brexit scenario, I don't think we can underestimate quite the significance that this risk aversion play could have on the markets. Let's see what else we can look at from a charts perspective. How about the US 30? We can see, look at that open today. Very much risk on appetite. We've broken back through these concerning levels that we broke through, which I'd highlighted on previous videos. The one thing that markets do not can account for is often is how to respond to specific levels, and whether the traders believe that areas are oversold, overbought, overextended. But the one thing we can't account for at times is these announcements which are not scheduled, and that's what we got here. We hung around the 50 fib level here. This is from the June lows to the August highs. We hung around the 50 fib level. We'd taken out these lows, which was concerning as far as I was concerned, especially considering the S&P 500 broke even lower than this, but we hung around the 50 fib, and now we've spared higher. If we see a breakthrough the 175s, then that will suggest to me that the markets are probably getting a bit overconfident on this Hillary Clinton news. We did see the Dow open around 250 points higher, which is around 1.5% today, and that was about an hour ago. But the next level of resistance here would be around these 18235s, which was a previous zone of resistance over the past 3 weeks or so. And then above here, we're looking at about 18375 to 18400. But again, if we're testing those levels ahead of the election results, I think we may be seeing another example of the markets getting a little bit carried away, as they did famously ahead of the Brexit vote. And now let's just bring up the S&P 500. Similarly, as you can see, we saw a far more significant break here. Here we still hung around the 61.8 to 50% retracement levels, again from those June lows to the August highs. We also had the moving average, the 200 and 233 day simple moving average band, which provided some support here. But we have seen that massive leg higher now. We are trading back through that support, so I'm not as concerned anymore about the indices, although that very much depends on the election outcome itself. Finally, the ultimate Trump risk off trade has been gold. We've seen gold rally back towards $1,300 a barrel, 1305, where it's not per barrel, but back up towards $1,300. Sorry, I'm confusing myself now with oil. It's rallied back towards $1,300, $1,305, where it did run into some resistance. Again, the fact that this coincided with the previous area support doesn't strike me as being coincidental. It struck me as suggesting that the market wasn't quite as bearish as to believe that, as to be pricing in a Trump victory, but the closing of the polls did spur it back towards these levels, where it held for around 3 days. The announcement was immediately met with heavy selling back towards around the 1280s, where it's now run into some support. You can see this 1270 to 1280 zone has been quite a notable zone of support and resistance really since June of 2013. We can see a number of occasions when this zone was a key level of support and resistance. So the fact that we're seeing some more support on this occasion doesn't surprise me. Should we see a breakthrough 1270, 1280, then I'll be looking back to around these 1250s once again. Prior level of support, historical level of support and resistance, and just to cap things off, we've got the 233-day simple moving average pulling in around these levels again. If we see a break of these 1250s, then I think we could be looking back towards these 1200s. It's never be surprised at how something like gold likes to move in these $50 bands. And I think, again, in the event of a Clinton victory, what that would mean for the Federal Reserve, I think ultimately that would be very bearish for gold. And I'd be surprised if 1250 managed to hold its position as a support for very long. For more in-depth news and analysis, check out OANDA Market Pulse at marketpulse.com. You can also find out more about OANDA and sign up for a free demo account at oanda.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.